The stock market can somehow see the future.
At the end of the week, my brokerage account contained over $2 million.
At 11:38 a.m. on January 28th, 1986,
2, 1, and liftoff.
the Challenger Space Shuttle launched, and 2 minutes later, it took more than 5 months to conclude that the cause of this explosion was the Space Shuttle's O-ring in the right solid fuel booster rocket, which was attributed to a company called Morton Thiokol. This was one of 4 of NASA's contractors.
Appeared to be breaking away from the shuttle and then explode.
About 20 minutes after the explosion, all 4 of the contractors for NASA's stocks went down, as expected. But Morton Thiokol was hit the hardest, and investors dumped their stocks so much that the trading was halted that day. On that day, nobody knew who to blame for that explosion, but somehow the markets knew. It's an interesting case of the wisdom of the crowds and how markets can reflect information that wasn't entirely obvious to us at the moment.
How many jelly beans do you think there are in this jar? So let's see how close they are collectively. Wow, that's extraordinary. If you remember, there were 4,510. The average guess to the nearest bean is 4,515.
The efficient market hypothesis is a theory in financial economics that posits that financial markets are informationally efficient, meaning that asset prices fully reflect all the available information at any given time. It was developed in the 1960s by economists named Eugene Fama. One implication of this is that it's impossible to achieve higher than average returns through stock picking or market timing because any new information that could impact an asset's price is incorporated into its value instantly. Breaking news of your company's stock, the market already knew this before you, and it's priced into the stock. A major war broke out impacting macroeconomic conditions. Bankers knew this 3 weeks ago, and it's all priced in. Jerome Powell and Janet Yellen started OnlyFans to offset the national debt. Priced in and subscribed. God bless America. The efficient market hypothesis is generally divided into 3 forms of the level of market efficiency. The weak form asserts that the current stock prices reflect all historical price and volume information. Therefore, technical analysis, which relies on past pricing trends, is ineffective at predicting future price movements because all of the relevant past information is already factored into the current price. The semi-strong form, or the moderate version of this hypothesis, asserts that stock prices reflect all publicly available information, including financial statements, news articles, or economic indicators. Therefore, neither technical analysis or fundamental analysis can give investors an edge. New information is quickly and accurately absorbed into the current stock price. The strong form, the strongest form, states that stock prices reflect all information, both public and private, meaning insider information as well. If this were true, not even insiders could have an advantage or get superior returns, as all relevant information is already incorporated into the current stock price. This one seems pretty obviously false, but we might want to ask Nancy Pelosi. The efficient market hypothesis has implications for broader financial systems as well as individual investors. If prices reflect all relevant information, there's no use in trying to pick a winner or loser or timing the market at all.
Hey, I'm Kramer. Welcome to Mad Money. Welcome to Kramerica. Other people want to make friends. I'm just trying to make you some money.
So the most prudent strategy on this assumption is to invest in a index fund and get market average returns over time. Also, you'd want to diversify since no single stock or asset is likely to outperform the market on a consistent basis and hold a broad portfolio of different asset classes. This is what I do, but only because information about the market scares me. There's also implications for the corporate world.
Can we make it 100 million?
For example, if a firm's stock accurately reflects all available information, then managers should just focus on maximizing long-term returns rather than, say, stock price manipulation or short-term strategies that have little lasting impact. but this is the current case.
Just exploding.
The hypothesis also seems to make active fund managers more or less obsolete. If markets are efficient, it becomes difficult for fund managers to consistently outperform the market. This might explain why many actively managed funds often fail to consistently beat the market benchmarks over long periods of time, a regression to the mean, especially after accounting for management fees and transaction costs. Often the winners are due to pure luck, an unfair advantage, or being Bill Wang. Financial market regulators like the Securities and Exchange Commission often operate with the assumption that efficient markets protect investors by ensuring that prices reflect all available information, so market transparency and the free flow of information are prioritized.
Hi, this is Gary Gensler.
Policies aimed at preventing insider trading are often grounded in this hypothesis, as insiders with insider information would have an unfair advantage and undermine market efficiency. If markets are already maximally efficient, then according to this hypothesis, government intervention should be minimal. Policies aimed at enhancing market transparency and ensuring information is disseminated effectively into the market should be prioritized, while excessive regulation, which could distort market prices or hinder the free flow of information, should be discouraged on this hypothesis. What's up, Ayn Criticisms. Despite its widespread acceptance, the efficient market hypothesis has been criticized on many grounds. Critics argue there are many instances where markets don't behave efficiently, as we see instances of financial bubbles, market crashes, and instances where prices deviate significantly from their intrinsic value. These irrational moments where markets behave erratically and inefficiently, scholars often term this not wisdom of the crowds, but madness of the mobs. Many behavioral economists disagree with the efficient market hypothesis. They argue that markets are not really driven by the rational use of information, rather they're driven by fear and greed. This would be an obvious insight if you just take a glance at Wall Street bets. Some empirical studies have shown that certain strategies, such as value investing, can actually outperform the market consistently, suggesting that markets may not always be fully efficient. The success of value investing, popularized by the likes of Benjamin Graham or Warren Buffett, has shed some doubt on at least the strong forms of the efficient market hypothesis. If markets were perfectly efficient, it would be impossible to consistently outperform the market using publicly available information. Yet some value investors have managed to do so for long periods of time.
Valuation is simple. We choose to make it complex.
Other anomalies, such as the small firm effect, where small cap firms tend to outperform large caps over time, or the January effect, where stocks tend to rise in January, also suggests that the markets may not always be fully efficient. This is not a suggestion to be very active with your investments. Rather, it's a warning not to be overly passive. You need to be versatile, like the guys on that famous trading app, Grindr. Andrew Lo,
I'm Andrew Lo,
MIT professor of finance, argues that markets are adaptive rather than being always irrational or efficient. His adaptive market hypothesis tries to apply principles from evolutionary biology into financial markets. It views the market as an ecosystem where various species or different types of investors compete for the scarce resources or profits. This competition drives adaptation and innovation in investment strategies, and investors adapt their strategies based off of past experiences and changing market conditions, just like in the wild. He explains that this adaptation can lead to periods where markets are relatively efficient because strategies are well matched to the environment, and periods of inefficiency where there's a mismatch during times of significant change.
Hey, there's a bubble.
The adaptive market hypothesis acknowledges that investors are not fully rational as assumed in the efficient market hypothesis. but neither are they always irrational. Instead, they exhibit bounded rationality, which leads them to make decisions that are good enough given their cognitive limitations and the complexities of the market environment. Again, to the analogy of evolution, different types of investors, retail investors, institutional investors, high-frequency traders, they all form this market ecology, and the interactions between these groups, their relative proportions, and their evolving strategies all contribute to the environment of market behavior. The adaptive market hypothesis explains phenomena like bubbles, crashes, and trends as a part of the natural market cycles of different players and different environments. These cycles emerge from continuous processes of competition, adaptation, and evolution of market participants and their strategies. This is a really novel and interesting contribution to the scholarly literature. Now, how do I make money out of it?
Sharpen your pencils, I'll get the paperwork ready.
The efficient market hypothesis remains a cornerstone in financial theory. It profoundly influenced the development of passive investment strategies and the development of index funds. However, ongoing debates about the market efficiencies have led to more nuanced perspectives.
The foundations of financial behavior and human dynamics, which involves applying the principles of psychology, neuroscience, evolutionary biology, and ecology to study the financial system.
The implications of these theories span multiple areas of finance, from investment strategies to corporate decision-making to market regulation and risk management. It's important to understand both the efficient market hypothesis as well as its critiques, as it provides a more comprehensive framework for financial professionals, and it encourages a more balanced approach to the general rationality of markets. In practice, this might mean maintaining a core passive investment strategy while allowing for some active management to exploit certain market inefficiencies that pop up. For me, this means buying gold bars from Costco and waiting until Roaring Kitty tweets something. Ultimately, these theories are just theories that are tools to understand how information is reflected in asset prices and how markets behave over time.
If you really want to buy something, you're going to find a way to buy it. If you really want to sell something, you're going to find a way to sell it.
It reminds us that markets are generally pretty efficient, and they're also complex and adaptive systems influenced by human behavior and changing conditions. Crowds can be wise, but mobs can also be mad.
The Challenger crew was pulling us into the future, and we'll continue to follow them.